Hi, and welcome back to Channel 11. I'm Ken Shinoda, your host today, and it is Thursday, February 1st. We're going to review January, and the title of today's show, No Free Money on Wall Street, because prices have gone up a lot on many assets since the last time we had a Channel 11 for you, which was November of last year. Before we start, I wanted to show kind of the story of 2023. This shows you the market's expectation of inflation in green and the market's expectation of real GDP, and it starts back at the beginning of 22 when the market expected pretty solid growth for the year 2023 looking ahead. And as time passed and rates went higher, the market started worrying about the recession that never came in 2023. And you can see that the negativity peaked around December of 22, February of 23, kind of right around Silicon Valley Bank going under in March. And then as we saw that no recession happened and growth started to tick up, GDP expectations picked up. So pretty crazy round trip as far as what everyone expected for the real GDP of 2023 in the economy. And we're kind of back to where we started. And so the real question is, do we stay up at these levels or does growth continue to slow? And I think the market expectation by economists is kind of a mixed bag, with some people saying soft landing, all is clear, and others still hanging on to their recession calls. So it's easy to have the soft landing narrative. The Fed's going to cut. Risk assets are near all-time highs on equities, but a couple things to keep our eyes on. This shows you cyclical employment in the blue and non-cyclical employment in the orange. And you can see that during times of recession or leading up to recession, usually that cyclical employment starts to drop, which makes sense. Those are more cyclical parts of the economy. And the non-cyclical parts of the economy, like healthcare and government jobs, holds up. And if you listen to the bears or read some of the bears, they talk a lot about the job market and how recent jobs have really been in things like healthcare and government jobs, and those cyclical jobs keep declining. So really critical next couple months are those jobs reports. That's also what the Fed wants to see a loosening of the job market before they cut rates. Another thing that we've talked about in the past is basically the state of the consumer. They all got stimulus checks. They had excess savings, north of $1 trillion. They've been dwindling that down. One of the signs that savings is declining is there's more use of credit card debt, and then you see higher credit card delinquencies. And this shows you the delinquencies are on the rise. They're kind of back to pre-COVID levels. They're definitely not as high as they were going into the GFC, but the trend is definitely upward, and the trend is the highest on those 18 to 29-year-olds. Those are the borrowers that have the most student debt. So we're still keeping our eye out on the consumer. They have been in a good spot, and you can see that through strong retail sales, some of the data that's pushed the Fed and the market to maybe hold on to this soft landing narrative, but we want to wait and watch and make sure that we don't see this creep up too much. And so, been a big repricing. This is a 3-month change in the market expectations of Fed funds, and it goes back to October, the end of October, which was right around when rates peaked. And you can see that the market thought that we'd see about 100 basis points of cuts at that point in time. That's come down pretty dramatically, with expectations of Fed funds to be down near 366 by this time next year. So that's a pretty big move. That's why equities have gone up so much. The market's definitely calling for more cuts than the Fed's dot plots, which say about 75 basis points. So the risk now in risk assets, I think, is that if you get again one of these whipsaw events where we go from soft landing narrative to maybe higher for longer and our economic data slows down. So when you're priced to perfection, as especially the equity markets look like, I think there's room for downside. What is the Fed going to do? Well, the Fed looks at inflation and they look at their forecasts of rates, and what's really important is the real policy rate. And the real policy rate is basically Fed funds less inflation, and you can see that it got really negative back in the beginning of 2022, where real policy rates relative to inflation were extremely loose, -8% for the real yield or real rate. And that's come up a lot with rates rising. Obviously, they've taken Fed funds up, and then inflation's starting to come down. So in theory, if inflation comes down, the Fed, if they want to keep policy rates the same, should start cutting in order to keep that real rate where it is today, or maybe even take it lower. And right now, based on Fed funds and the path of inflation, they're going to keep real yields pretty high at 2%. And this is, some of the bears point to this and say that's really restrictive. But we've seen real rates much higher than this pre-GFC. And so that's up for debate whether a 2% real yield is really restrictive. Perhaps in the world post-global financial crisis it was, but in a world of higher growth, higher inflation, perhaps we should have that higher real yield. This is a chart that is in our new blog on LinkedIn. It's called Between the Lines. Please check that out. That's with our macro asset allocation team, Sam Garza, Ryan Kimmel, and Faye, and we'd love for you guys to support that blog. All right, here's another interesting chart. This one we borrowed from Apollo, and they have the former chief economist from Deutsche Bank, and this just shows you a chart of basically how long it took between the last Fed hike and the first Fed cut. On average, 8 months. We're right there. If we cut in March, I'm going to take the over based on what Powell was saying in his in the press yesterday. I think that they're probably going to wait till the summer unless data really deteriorates to the downside. So I'm in the kind of the first cut will be in May or the summer, and we'll just have to wait how that data comes in. But inflation has definitely been on the drop. On the left-hand side, you can see core PCE now coming in sub 3%. If you look at 3 and 6 month PCE, it's well below 3%, on its way towards 2%. And this is definitely given the Fed confidence to pivot their language. And I think one of the key things to think about is it doesn't really matter, when they cut, I think, right? It's more about that they can cut. You go back 6 to 12 months, inflation's still high. They didn't have the ability to cut. There was no Fed put in the marketplace. But with inflation having meaningfully dropped, I think that the most important thing is less about, what date that first cut happens, but that they have that ability to cut rates, and they could cut rates meaningfully if needed. And I think that is really interesting from an allocation standpoint, because for the last 2 years, bonds have not given you protection from equity weakness. Stocks and bonds have had a positive correlation, but as CPI comes down, that gives the ability for stocks and bonds to have more negative correlation potentially. So that's something I think that's interesting for asset allocation. Bonds have not helped you relative to equity weakness, but I think they will again, given inflation's come down to lower levels. So what else is out there that gives us hope that inflation can stay low and perhaps not have a spike up? One of the things that's been a component of the core PCE and core CPI is shelter, right? Home prices have been on a tear over the last couple of years. I know they saw a little bit of dip down. Rents have continuously been on a rise, but there's a lot of multifamily coming online. That should help take pressure off rents. And as interest rates come down, that's actually going to help bring supply to the single family market as buyers and sellers of single family homes decide that, I didn't want to sell and buy a new place when mortgage rates were 7% because I'm locked into this 3% mortgage. But you know what? If mortgage rates are 5%, 5.5%, maybe I'll, sell my starter home and buy that bigger house because I went into my starter home with 1 kid and now I got 3. And then you've got the baby boomers that wanted to downsize, and downsizing was upsizing. So I think the combination of more multifamily supply plus the unlocking of the frozen housing market will help to decrease pressure on rents. Rents are going to start to come down, and that's going to help the owner's equivalent rent of core CPI. What the Fed's worried about is the hot job market, right? And the fact that while wages are down, this shows you different metrics of the increase in wages. They're still much, much higher than they were during kind of like the low inflation, low growth, or the new normal days, as PIMCO used to call it, in that kind of post-GFC era, 2010 to 2018, 19, where you saw wage growth around 2 to 3%. We're still elevated. So the Fed wants to see this wage growth come down. This drives into services inflation. And that's what they really want to see more traction on. That's why Powell was stating he wanted to see kind of wait and see the data. If they wait till March, they get 2 more CPI prints. They get 2 more jobs reports. If they wait till late May, they get even more. So they want to see more progress here. The other things that they're potentially worried about, which they didn't want to move too quickly, is that there's some geopolitical tensions going on, and shipping costs have potentially could be on the rise. And this shows you the correlation of goods inflation with shipping costs. This is Shanghai to Rotterdam container freight rates, and they've been on the rise because of the geopolitical stuff going on. So that's kind of what they're looking at. They want to wait and see, and I think that's what they're going to do. And frankly, Powell told you that they're going to do that. So with all this disinflation that we just looked at, with the dovish pivot that kind of happened towards the end of last year, it ended up being a pretty good year for fixed income. A lot of these returns on the far left, which are higher quality parts of fixed income, were negative until the fourth quarter, but high quality fixed income, you can see treasuries, agency mortgages, kind of ended the year up 4 to 5%, basically earning their carry. The 10-year treasury yield almost closed exactly where it opened at the beginning of the year, around 380. And the best place to be was credit, which everyone thought at the beginning of last year was the worst place to be. Everybody thought sell stocks, sell risky credit, buy high quality bonds, and it turned out that you should stay in your stocks and own your high quality bond, your risky bonds. And look at those returns. There's teens type returns across the levered loan market, triple B CLOs. Much of the securitized space did, mid to high single digits as well. Corporate bonds with that big rally in the fourth quarter in rates also ended up doing okay, up 8.5%, having been negative at one point in time. So the only place that lagged was the commercial mortgage-backed securities market, the riskier parts of that. The only thing negative on my page here, which is not every asset class out there, is those triple B commercial mortgage-backed securities bond, which, by the way, are the best performers this year. We'll see that in a second. Moving on to equities, what a year it was for equities. The land of gains in the gray is 2023 year-to-date returns. NASDAQ doing the best, and also Japan being on a tear there. And you can see in the blue is this year-to-date. Japan again in the lead here, and equity is up a little bit. International equity is not faring so well. So the U.S. definitely was faring better than the rest of the world. A lot of that was that Magnificent Seven, the mega cap tech. But the growth in the U.S. is better than it is globally. And you can see that, Europe almost in a recession, China having problems with the property market, potentially coming out with more stimulus there. So I'm not surprised that the U.S. equities have done well, but they are the most expensive equities out there now. Looking at across subsectors, again, last year, just insane returns in some of the information technology and some of those mega cap names, and kind of like a mixed bag elsewhere. Some sectors, like utilities, defensive sector, not really doing that well. So it's been a thin leadership in the equity market. I think we all know that. Towards the middle of last year, investors making bets on a broadening of the strength. And the second we kind of moved away from the higher for longer mantra, and we went to that dovish pivot, and we saw that some of these other sectors weren't really growing, and worries about earnings contraction. It was back to the growth stocks, and that's what's leading the way yet again this year. Growth up 5%, momentum chasing growth up 7%, and a lot of the other parts of the equity market lagging. So we're back to that that thin breadth in the market, or low breadth in the market, with just a few names leading the way again in the equity market. And some indicators. This was from Goldman this morning, showing that the futures positions just really high. A lot of futures positions chasing the market higher, and this is where I think you start getting worried from an investment standpoint. It doesn't mean that you need to sell your equities, but it just doesn't seem like a great time to add risk, both in the credit markets, given credit spreads have ripped, but also in the equity markets. I like cash here just as from optionality. It still earns 5%. The Fed's going to keep it up there for maybe a couple more months, maybe 6 more months, and wait for something to shake the markets up that will lead to a better buying opportunity in risky assets. This is CTA equity positioning, and you can say this is also really high. And it's gotten higher, obviously, in the past, but This is just another sign of you've had the machines basically chasing this market up, and maybe a thought for pause here as we look for asset allocation. Maybe we're going to get a better chance to add. So I guess that the only thing that looks cheap, and as you think about the equity market, is with equity prices going up so high, VIX has dropped a lot. That's the volatility of equities, so protection looks pretty cheap. The problem with buying VIX is that the curve of volatility is so steep. If the market doesn't drop immediately, you lose money. So for simplistically, that's why I go back to cash. Cash looks interesting now. Just kind of wait and see what cheapens up here. I think you'll get a buying opportunity in something in the next couple months, I think. Commodities were broadly weak last year, down 13% for the commodity index in the gray. Gold was like the only thing that was up. And this year, you've had some strength in the far left. You can see the WTI and Brent crude up 5-6%. You would think that they would be up more given the geopolitical risks that are out there in the Middle East. And so the other parts of the commodity market continue to be weak. So this to me is a sign of global growth being slow. I think China has a lot to do with this. This is positive for bonds. This is positive for that continued deflationary move that we've seen in global inflation. So this, I think, is a positive thing for bonds. It's obviously not good if you own commodities, but I think that this is one of those things that is a sign that the global growth continues to slow. And why has the U.S. been so strong? We had a ton of fiscal stimulus, more so than the rest of the globe. This is just a broader snapshot showing that commodity weakness that really peaked in 2022 has been continuing lower there. 10-year Treasury yield, we got all the way up to 5%. I started getting emails from people, sending me stuff about XYZ person says rates are going to 6, rates are going to 7. It was almost a perfect top because there was peak bearishness for bonds. Nobody wanted to touch them, and they saw a monster rally all the way down to sub 4% here. I think we're going to run out of steam a little bit, potentially. We're hitting this kind of technical level in the 390 area, 385-ish. If it does break through, the low of last year, which was that 330 area, is probably the next stop. I'm not saying it's going to go there. I'm probably would say, don't chase this rally. If, the Fed's not going to cut and we get some more positive growth data, you could probably see rates back up again. So we're kind of neutral in our duration stance. We do have a longer duration in many of our portfolios than we've had in a long time, just given the absolute level of rates. But from a short-term technical standpoint, the market's seen a pretty decent rally. Maybe hold off on tactically adding duration here, especially on that front end of the curve that's more policy sensitive. The dollar has really followed the 10-year Treasury yield. You can see here the dollar is in blue, the 10-year Treasury yield is in red. So with the rally in rates, you would think that you'll start to see some potential dollar weakness here. Keep our eyes out on this. If the dollar weakens, that can be good and give some tailwinds to some of the emerging markets, which have lagged. The only problem is the geopolitical risk out there makes it hard to get into that emerging market trade. And emerging market equities have definitely suffered. Emerging market fixed income had a rip-roaring fourth quarter. Some of the riskier parts of EM, we had portfolios that had EM sectors up double digits in the last quarter, 15, 16+%, with that the dovish pivot in. So what does that mean for 2024? Well, it's kind of in a sideways market. Rates, the 10-year opened up around 380s. It's right around there. So treasuries are slightly down. The index is slightly down. These were down way more a week or two ago. We've seen a rally in the treasury market recently. And so the worst part of the market last year, CMBS is the best part, up 7.2%. You're seeing a catch up. We talked in November on Channel 11 how corporate credit had rallied first, both IG and high yield, and many parts of the securitized markets like non-agency mortgages and asset-backed securities and CMBS had lagged. And so while these assets do have duration, so from a duration standpoint, their prices would be down, spreads are tightening. And so you've seen a rally, especially in the most unloved part of the market, which is CMBS. And there you go again, yet again, 3 years in a row, bank loans winning given their floating rate. Not winning by a lot, but winning nonetheless. So This is the scoreboard for 2024 through January. And here is that chart that we looked at. And we looked at this a couple times, which shows you the securitized sectors relative to corporates. And you've seen this, the catch-up starting. Why you don't see more of a catch-up is that corporates have ripped too. Corporate spreads are now around 10th percentile, 10th to 12th percentile, meaning that they've only been this expensive about 10% of the trading days over the last 10 years. And we believe that absent a macro event and sell-off in equities, that you'll probably continue to see a reversion of the mean of the securitized sectors versus corporates. This shows you the higher quality parts of those securitized sectors. CMBS was the widest relative to corporates, and that's playing the biggest catch-up, as we just saw. This is one of my favorite charts. I have a lot of favorite charts, but this is one of my favorite charts, and this is the what's cheap report in fixed income. And you can see in the very bottom, investment grade and high yield having had monster spread rallies. Looking on the expensive side, high yield as of, I think this is as of last night, 21st percentile. It was even more expensive a few days ago. And saw a little bit of spread widening yesterday with the equities down. And the securitized sectors, all those, RMBS, ABS, CLO, BBs, those were all kind of up in the mid 80th percentile back in November. Agency mortgages were up north of 90. CMBS was also up north of 90. Everything has come down on this report, about 15-20%. Still looking cheap on a relative basis, still better than average, right? 50% there being average, or 50th percentile being average. And these continue to catch up. As I speak to you today, upstairs on the trading desk, we're seeing spreads continue to grind tighter across these different asset classes. And what's interesting is this shows you commercial real estate prices. They're down, especially office. Office prices are down, and you'll wonder, why are CMBS prices up when office valuations are down? Well, it's priced in. And CMBS was a sector that in the summer of last year, after Silicon Valley Bank, was basically pricing in a depression. That nobody would ever use office space, and that rates are going to infinity. Nobody can get debt. And what's happening is two things have really helped the commercial market broadly, and not saying that prices can't go down, but just sentiment and the willingness of investors to come in and both buy the debt but also buy the equity to trade properties, is that the Fed pivot gave us kind of a ceiling on rates, right? So the market started saying, okay, well, the 10-year is not going to 8%. Maybe it's going to settle down and be around this 4% we are today. And if the 10-year is around 4%, maybe I can borrow at 6%, 5.5%. Maybe I can refinance that debt to a lower cost of funds, a few years from now when inflation is lower and the Fed cuts. And that means that buyers of real estate are willing to step in and purchase an asset because they think they can get debt, or they're now able to get debt because the debt markets are opening back up. And lenders are willing to lend, and debt buyers are willing to buy bonds because they can actually place a value on it. The problem we had through most of the last year is we didn't really see properties trade hands, right? There's wide bid ask. Somebody wanted to buy office building at a 10 cap unlevered, and the seller wanted to sell it at 8 cap, right? And just nothing traded hands. Now you're actually seeing transactions happen, which now gives both buyers of real estate, sellers of real estate, and the lenders and debt buyers an idea of value. And once you can assign value to a property, you know what your risk is, right? And especially as a lender, now there's more clarity on value. You can price loan to value and where your leverage is as that bond holder or the debt holder. And so people are now willing to take risk and take these bets. And another thing that's interesting is apartments are down. So you wonder, I thought multifamily could never go lower. Well, this isn't all multifamily, but multifamily was priced to perfection. At the peak, people are buying these properties at a 3% cap rate, and the 10-year Treasury yields 4 now. So they got to be down in price. And the problem that a lot of the buyers that bought at the peak was that not only did they buy to a 3% cap rate, was that they maybe took out a floating rate loan because they were going to fix the property up, trying to get rents up, and rents are not going up. They're going down, as we talked about earlier, and their debt cost is much higher. So there's a lot of underwater multifamily out there. It's going to be an interesting buying opportunity for fresh capital, both on the equity and debt side. And we're really excited about opportunities in the commercial real estate market because it's the only place that is not pricing in soft landing. It is pricing in hard landing. So you want to buy assets and you want to lend on assets when they're, pricing in stress. And this is one of the only places in the marketplace that's pricing in stress. Everywhere else is Goldilocks. Stocks are at all-time highs. So out of consensus, thought there for investing is in commercial real estate, which is the only place that's pricing in that recession still today. Now, you may think, I missed it. You didn't. Yes, spreads have come in a lot. There's still some more to run on some of these sectors. As I noted, IG and high yield look the most expensive, but all-in yields are still high relative to history. So, and spreads can widen. Something can shake up the market. Spreads can widen tomorrow. So I'm not deterring you from buying assets. I'm just telling you where valuations are, and we've had a rip-roaring fourth quarter and a start to January. But all-in yields are still attractive. This is investment grade. You can see you're still getting mid kind of single-digit yields, 5-6%. Used to be 7-8% about a month ago. And then the below investment grade space still high single-digit and teens in some of these sectors. So there are equity-like returns still in the bond market, especially if you mix a little bit of the high quality with the lower quality. Understanding that obviously, more below investment grade parts of fixed income will have more equity-type volatility, but we do think that still relative to equities, this looks interesting. If you want to be a little bit more tactical, wait for a little bit of a shakeup. Stocks go down 5%, 10%, spreads will widen, and you'll get a chance to come in at wider spreads, but yields may be lower. And that's something we talked about also last couple of Channel 11s is, yes, you got to look at spreads, but when spreads are widening, what's happening with the base rates? Base rates could be lower. So while spreads could be wider in some of these sectors, all-in yields may not be that much higher. So, and I mentioned this on Bloomberg that was on yesterday, come out of those T-bills. Just a little bit, come out of those T-bills. I know they yield 5% still, and that is really great, but you want to try to lock in some of those yields. And since these spreads are tight in some of these risky sectors, maybe just look at higher quality fixed income today until you see a little bit of a shakeup in those risk markets. And I'll end with one last slide about bonds. Supply demand is a powerful thing, and the supply, because spreads were so wide, is coming down based on our estimates. 2024 issuance across corporate and securitized markets should be down, which should be a tailwind. We're kind of seeing that right now, which is why some of these spreads are tightening in. If I showed you the same thing for treasuries, it doesn't look quite the same, which is why some people are more negative on treasuries. But that's the market today. I guess I'll summarize that, we've had a big run in risk assets. Everything seems a little too priced to perfection in Goldilocks. And so, cash looks interesting. And that just means, take a step back, wait for a buying opportunity. CMBS and commercial real estate broadly is the one part of the market that's beaten up. While CMBS has had a run, I still think there's upside there. But maybe try to think about ways to play that stress in the commercial market. Fresh capital put to work could be an interesting place to be. So thanks again. Have a great year. Good luck. And we'll see you next month. Thank you.